Robschild. Nothing I say is investment advice. Welcome to the show where we view financial markets through crystal ball gazing. J.P. Morgan once said millionaires don't need astrologers, but billionaires do, and so we begin. Today is Thursday, March 14th, 2024. We had PPI come out today. All the headlines said, oh, it's so hot, it's so hot. The economy's on fire, and rates went through the roof on the long end of the curve, and everybody's going crazy. The Fed funds rate are looking at, more hawkish looking Fed. I look at these numbers and I say, really? I mean, okay, let's go through them real quick. The PPI, previous 0, forecast 0.3, actual 0.6. This was the biggest surprise month over month. When it comes to information month over month, it's good to take it with a big grain of salt. I know even on this show sometimes I take month over month and I say, oh, look, a clue, maybe it's going this direction. And that's the thing, we're all human, and the market is a human in a way too, and has psychology to it. And so certain things are going to spook markets in different ways at different times, but it's always good to take a step back and always realize that any data coming out could be a one-off situation, and we could easily flip the other way or continue getting, much worse into the future than what is expected, from the current projection of where things were and where things are going. And so it's good to take all of this with a huge grain of salt. But moving on, yes, the PPI straight up looks pretty inflationary, but then when we look at the core, the previous month over month was 0.6, the forecast was 0.2, and it was 0.4. So in other words, it went down from the previous month's increase of PPI month over month, but it didn't, it decreased at the rate, right? But it was expected to be decreasing at a faster rate, so it's not decreasing fast enough. That doesn't spell out super hot to me. Not super hot anyway, maybe a little hot. And then PPI year over year, previous was 3.1, and 1.6, and then the previous 2.7, and for the core, and 2.8. And so these numbers, this is interesting. The regular year over year, we have this big drop year over year, and then the core only ticks up a little bit. Okay, hold on a second. My data is wrong. This is 1.0. Remember, nothing on this show is investment advice. I digress. So yeah, the previous being 1%, and then year over year 1.6%. So yeah, that makes a little more sense. I looked at that number like, well, that doesn't make sense. If the month over month is higher than expected, how can the year over year be going down from the previous? Okay, so anyway, no, it did go up from the previous. And so I could see how this could spook the markets to some degree. But then you look at the core, and it's like it's pretty much flat. And then we look at initial jobless claims. Last month was 210,000. We are expecting that to go up, and instead it went down. So less people are losing their jobs, and that is hot data. Is it crazy hot? I wouldn't describe it that way. The other number that was interesting to me was the retail sales number coming out. Previous was negative 1.1. The forecast was 0.8, and it was actually lower than expected. So in other words, people are spending a little bit less money, but the companies are willing to spend a little bit more for their products than was expected. And so the idea here being that when companies are paying more to make stuff, they usually pass that on to consumers after the fact. And so a lot of times you can expect CPI to follow PPI. So PPI goes up and then CPI goes up. So we'll see how that works out. Again, I don't see anything here that I'm like that's flipping my lid at the moment. So let's move on to the charts. There weren't a whole lot of charts that were terribly interesting to me today. The S&P 500, this is not the S&P 500. It basically went flat. We're not breaking higher or lower today. But the first one I wanted to share with you is high yield corporate. I share this chart a lot because it's, this is where like bankruptcy risk is for like bigger, more intelligent, institutional investors. This is a powerhouse of a market to keep track of as far as risk goes. And we saw, interestingly, a big red candle today on high yield corporate hitting exactly this line that I had drawn before from these highs. And so, is this going to give us some support here, or are we set to break down? I think we are set to break down. I have been mentioning in previous shows, I think we're set for a major correction, if not the beginning of the end of the stock market for a while. There are periods in history where everyone hates all stocks. We are not in one of those periods right now. We're in the opposite. We're in the period where everybody's so happy about stocks and exuberant, and everyone's rich and everyone's happy. It's a good thing to remember that there are periods where everybody's happy, and there are periods where everyone wishes they didn't have a single stock of a single darn thing. And I think that we may be headed into a period that looks a little bit more like that sooner than most other people might think. After yesterday's home builder index had made a new high, closing and intraday, we had a engulfing red candle. If you can look that up, if you don't know what it is, it means basically a solid red candle that takes out a bunch of previous days, and it almost did. It's not actually a completely an engulfing candle. Normally we would want to see the top of the candle higher and the bottom of the candle lower, but it has the look to it. It looks like an engulfing candle. It's a big red one. And so I think that this could indicate a possible reversal in home builders for the moment. Next chart I wanted to point out was actually ARK K. We have been holding this trend line since the beginning of February, bouncing off of it, and we broke through it very recently. And so we definitely see some weakness here in ARK. Again, I like taking a look at ARK K, as that's the flagship of Cathie Wood. That's the that was the headline ETF that performed better than anything during COVID because of the fact that everything in it is so interest rate sensitive, and interest rates went basically to zero, and everything in her funds are great for COVID because it forces a lot of innovation. It was a perfect mix of everything to make her strategies work perfectly. And so I like to keep an eye on this market still. I think longer term investing, this still is a good place to be, just because of the idea of even Benjamin Graham talks about this groundbreaking technology that like changes industries, and I mean that's what she does, and Graham talks about that. And part of the collapse of the railroads was cars and roads, and that was the innovation of the time. And so it's definitely, this ETF ARK K is definitely one to be taken seriously, and I think important to keep tabs on. Last chart I wanted to point out today, again, the 30-year yield. I know I've been talking about very similar charts lately, but these are the most interesting ones. to me right now as to what's going on. It's not always this exciting. A lot of times there's other markets that are showing more interesting moves, but the 30-year Treasury yield is it's very important. It's very significant in its weight in the valuations of all markets for many reasons, as I talked about on previous shows. So, I just realized today that I had been calling this right here a head and shoulders, right here, a shoulder and a head and potentially another shoulder. But the reality is, is that these lines here, they're parallel. This shoulder, when you take a look at the neckline here, I'm not sure this counts as a shoulder just because it was lower than the head. Well, the neckline's on an angle, so I'm actually not sure how that plays out. But these are actually parallel lines, and so it's the way I'm looking at it now is that this is starting to look to me like it's actually more of what we call a channel, and so it can be expected for us to continue hitting the bottom and the top and the bottom and the top, and we could stay in this for a long time, really. Another way to look at this chart too is potentially a bear flag too. That's another way to see it. So you see the pole here, and then our flag, and a very perfect channel flag. And if it breaks down, then again we expect the length of the pole to be equal to the length of the breakout below the flag. And so, rough estimate 3.5% if we were to break down lower from there. So that's all I have for you today on today's show. I hope you enjoyed, and thank you very much for watching. Robschild.